Hey guys, super happy to be here once again. And today I'm very, very excited because uh, in most of the times that I'm having a recording session, I'm very, very expecting for such a conversation like today's conversation. It's a conversation that we will be diving into the world of academia, and we're going to be taking the world of academia and we're going to be applying it over in the industry itself. I think that the conversation today will be extremely uh, interesting in many, many terms because of and obviously thank for the participation of our guest today. So Ben Charoenwong, thank you very much for coming here. I'm very, very excited for today's conversation. And before we're going to be starting the session itself, I would love to hear how are you and how's everything in your end.
Yeah, Afek, thank you for having me. It's a
The
pleasure to
pleasure is
be
mine.
here
The pleasure is mine.
to talk a bit about, kind of stuff that we do both in academia as well as in the industry. I'm doing very well, thank you. It's a tough time out here in the markets, tough from a labor markets perspective, tough from financial markets, of course, tough for uh, life in general. But humans are adaptable and resilient, and a common theme we'll be talking about today, I think, will be on risk management, right? We're kind of at this cusp of a lot of disruptions, not just from any single event, but there's actually multiple things going on at once. Yeah,
Mhm.
so I'm happy to dive into these together with you.
Brilliant, brilliant. So before we're going to be starting the conversation itself, I would love if you can tell a bit about yourself to the audience.
Yeah, sure. So I was born in the US. My name Charoenwong. It's Thai. My parents are Thai. I was born in America while they were doing their PhDs in finance. And then we moved back from the US to Thailand briefly and then to Singapore. So being, a son of two finance professors, you can imagine what conversations at the dinner table were like. Actually, both of them
Not
encouraged me
about food,
not.
I guess. Not about food.
Yeah,
Well, it could be about
it's
food, but
interesting.
not most
Yeah.
of the time.
My dad is actually a very picky eater, not because he can't eat a bunch of stuff, but it's because he is a pretty good cook. So if we go to a restaurant where he can cook something better, he's going to say like, "Hey, why are we here?" Right? I could just cook this at home.
Let's
Uh,
go back home. Let's leave the
that's
table.
right. Yeah, that's right. Yeah, so it was interesting. I mean, we didn't talk that much about academic stuff. Actually, both of them encouraged me not to go into the industry. The industry meaning academia.
Really?
And yeah,
That's
yeah. So
surprising. So
so
they
they never
actually
pushed
started
it.
the today's revolution with not going to school or not approaching academia like by
Yeah,
doing
so definitely
the
the
thing now.
undertone was they value education a lot, right? But they never like pushed us into us, meaning me and my siblings, my younger siblings, into going into academia, and yet most of us end up in academia. So two out of the three, partly just because you see the lifestyle, and you see like when we discuss later, the life of a professor is actually quite pleasant, meaning you have like a fair amount of control over your life, which might not be the case in certain sectors. And so, we just kind of got drawn naturally. I remember when I was getting my PhD, so I did my PhD at the University of Chicago. As I was graduating, or thinking about what to do, and I was interviewing. I was interviewing, of course, with pod shops, right? Citadel. I applied to a couple other fund management roles, corporate advisory roles, and then started getting some offers or getting to the final round, and you're kind of negotiating parts of the job and what it would look like. And then you realize, wait, if I join corporate, you kind of, I really felt this sense. Maybe it's not right, but they had the sense that you kind of are selling yourself and your time, right, to become like a cog in the machine, at least for a while, right, before you kind of have some control over your life in terms of like the direction you want to go. And so it felt a little disempowering. And so at that point, I decided, I thought, you know what, being a professor is good. You show up, you teach like that to that extent. Of course, that is, the obligation as
Mhm.
an academic. But in terms of doing research, you get to pick the stuff that you want to do. And a unique part about being a finance professor in particular is you can do research on stuff that could potentially make money in the industry. Meaning, you can do academic research testing new theories, whereby the way to test it is actually to ask, can this be a profitable trading strategy?
Mhm.
Right. So as a consequence, because there's like such a close tie between academia and industry, the pay for finance professors typically is quite good. Right. And then you have some faculty members straddling in and out of the industry.
Mhm. Very interesting. Well, obviously, you're an associate professor in INSEAD, which is it. Please fix me if I'm wrong. The second economics school in Asia,
Yeah, we're
besides
number two in the
number
Financial
two
Times Global MBA
in
ranking
financial
this
science.
year. Yeah.
So you're actually lecturing and leading students with their research and with their, I don't know, prototypes that they're actually developing. And we have spoken about the intersection and the consequences of doing a proper research, like in the lens of the academia. But on the other hand, you need to properly assist to guide and to give a light over the industry itself, which is like most of the times it won't be correlated so much as we mentioned here, and it is a major challenge to understand the gap in the academics. In how the academic procedure is actually working and aligning that with the industry itself. And I would like to ask you, how do you lecture your students in order to be successful in their research, but again, taking the research and knowing how to leverage it over the industry itself?
Yeah, that's a very deep question. Um,
Sorry for that.
yeah. Yeah, so it's also something I've been thinking a lot about because, of course, like when we talk about crafting your career, right, I had to decide about how I wanted to craft my career and the kind of stuff that I would want to balance and work on. So I have a very strong belief, right, that like the number one resource, actually the most scarce resource is your time, right? And so when you are willing to give up your time or trade your time for things like dollars, right, there's like a shadow price behind everything that we do. And of course, that's one of the first things they teach us at the University of Chicago, right? You learn opportunity costs, and then all of finance is built on thinking about what is the opportunity cost of capital, right? Of course, there's also the opportunity cost of time. Um, yeah, so I think as an educator, when you think about like finance schools, right, you might think of Chicago, right, Wharton, where a bunch of the faculty at Wharton are
Hmm.
PhDs from Chicago, right, and then at Chicago is really where the finance as a field actually started as an area of study. It used to be housed under economics, right, and then
Hmm.
there it kind of really sprung forth into its own area of study. And of course, there's at the first initial maybe couple decades, there was a lot of overlap between deploying stuff in industry and researching things in academia. That is, we're trying to understand financial markets, and in understanding financial markets deeply, many also went to do practice in the financial markets itself. Um, there is a little bit, right, of feeling that, over time, as an area starts to become a bit more mature, that, people are sitting in the ivory tower coming out with theories and teaching theories that might be wrong or not appropriate in some way for practice. And I think that's where I think straddling academia and industry, like, being a professor and running a small fund of my own, it kind of keeps me a little bit more humble, right? Meaning, like, even though I teach some theories which I think are not quite true in the data, it might still be a useful framework, right, to think about risk and reward and things like that. So our job in academia is to train people how to think,
Hmm.
right? In a time now with AI, which I'm sure we'll get to in a bit,
Uh,
there's
I
tremendous
think we
disruption.
will. It's
Yeah,
unavoidable.
yeah, that's right. So it's everywhere. And there's tremendous disruption, but really, like this idea that you come to school to get knowledge, I think that is starting for the vast majority of people. I don't think that could be the reason for them to come to school anymore. I think they come to school for other stuff, right? They're like kind of peer learning, right? There's spillovers, experiential learning, different styles. And so, of course, academia, I think, needs to adapt to that. And so for me, when I
You
design my
actually believe
class,
that the academia will adapt to the new to the new era of learning capabilities? Because
yeah, that's a yeah.
I doubt it. Here in Israel, well, you can see we have the Technion here, which is 12th in tech school, like globally, and I see their adaptation, which is literally nothing. And I cannot actually, forecast the adaptation in the future of academic institutions towards like the revolution that it's actually happening because of the research and because of the of the learning and consuming path that the academia
Right.
itself is actually taught into. So, what do you think about it?
Yeah, so I think if I still remember, so before I joined INSEAD, I was a professor at the National University of Singapore, which is, a decent school in Asia. But when the AI came out, the knee-jerk reaction is how do I stop students from cheating, right? Or using it on their homework. And I think, okay, that might be the
In
very short
Singapore,
term.
in
Yeah, so
Singapore,
that's right. Yeah, that and then Singapore already is kind
really
of
cheating
like
in Singapore? You know.
yeah, and that's where yeah, Singapore is already towards the forefront, right, of using some of these technologies. And so
No, well, that's
that was
awesome.
the knee-jerk reaction, right? And that was like I was with colleagues hanging out at lunch and they're asking, how do you stop your students from using it? My stance was always it's that is like a whack-a-mole, right? Meaning like we can play that game. It's going to be very difficult,
Hmm.
right? And I think for certain classes, maybe you do need to do that because you just need them to sit, students to sit in your class and like learn how to do that calculation by hand. But for like I taught mostly applied stuff, so kind of the more advanced level stuff that kind of combines materials across different classes, and then stuff that I thought is a little bit more relevant in the real world in terms of like the kind of job that people will be doing. And so really that became a huge opportunity for me because, instead of having to cover three areas all at once, I can cover, a bit enough from each and then have students self-learn by using the AI so long as I can give them prompts and stuff like that. So it became, I think, a very powerful tool in my class. And then when I moved to INSEAD, the discussions we have there constantly in like almost every faculty town hall, if not every single faculty town hall, is how can we use AI to transform the learning experience for students? And to me, like that's really was inspiring that, I'm not saying all professors are experts in AI, but it's that mindset to say we need to adapt. How do we change our program, redesign
Beautiful.
classes, yeah, so I feel like that has to be
Beautiful.
the case. And effect to your point, like if the school does not react at all, right, I think they're just waiting to get disrupted, right? And then in that sense, maybe they don't react now, but the market will force them to react, right? If you have lower enrollment numbers and things like that, or your students can't place. Yeah.
Unfortunately speaking, I look, I would be frank with you, and I was able, with the assistance of artificial intelligence, to write a paper, a very applied paper about market profile. So I was working about like manipulating level one data with market profile and understanding where the gravitation of the participation in the market actually is using artificial intelligence and to surprise you, Ben, and to surprise and to for the surprise of all of our listeners, I was able to actually craft a state-of-the-art paper which I was refining with a friend of mine, and he's a computer scientist, a professor in computer science here in Ben Gurion University, which is a university in southern Israel, one of the best here in Israel and top 15 in the world. So I was able to actually refine the paper that I was written with the professor, but I wasn't really the main writer of the paper itself, and I'm actually, taking many of in constitution in order to actually proceed with the research type, which is very, very applied to the industry itself. And I do think that the intersection gets like tightened each and every single time with a new model release, and with as long as you intervene more with the technology, you see how the intersection itself get minimized. and even though the intersection get might get disappeared because it aligns perfectly. I do think that critical thinking with academic advancements with and AI on top of it is like the perfect triangle of, gathering everything into a major understanding and a major force to your own arsenal toolkit. Um, so, okay, you take AI, you force your students to use AI. How do you force them to think critically in order to take their research studies and proceed very, 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 very heavily with the usage of AI? How do you force them to think critically? How do you force them to leverage their creativity and the machine itself in order to provide you with the state-of-the-art work? As long as it's
Yeah,
possible,
that
to provide you
the
with
yeah,
state-of-the-art
thank you
work.
for asking that question. And to your point, we're thinking about what makes something applied, right? Applied in what sense? It generates something usable, right? So maybe usable in their day-to-day life or in their career, right?
Yeah.
Um,
Which
and
is the,
so
the,
what
the the generic definition of applied.
Yes, yes.
Okay.
So to me, that becomes the way that manifests in class would be things that's like more related to projects, right?
Mhm.
Projects, independent study modules. The funny thing is, we used to take students and like force them to think and do exercises and frameworks and stuff like that. But increasingly, what matters more is drive. So to your point, creativity and drive, like those two need to be there. Like to me, like, you kind of say, ask and you shall be given, right? And then what we realize is actually that is enough to differentiate a lot of people, meaning most people don't want to ask. They're not that curious, right? And so
Mhm.
I think to become the top 10%, the top 1%, the number one thing is like, are you curious, right? Do you have like this personality of wanting to learn more, to develop yourself? And if so, when you tap upon unlimited knowledge and resources from the AI, right? And with some guidance from researchers, you can get really, really far. And so for me, I teach electives in INSEAD, and so we focus much more on project stuff. So certain things I force them to do calculations in class. So now I just have, give out the handout and like just stand in the middle of the lecture room looking around, like, can you guys do the math? Just confirm it with me once. And then after that, right, we're going to work on the project. And then the projects will be much more involved, right? A project used to be something like, hey, let's form a trading strategy. Now it's like let's form a whole fund. What's the pitch? What's the market, right? Who are the investors? What kind of risk profile? So what it ends up doing is becoming much more applied, meaning you're going across domains to kind of put
Exactly.
this problem
Yeah.
together. Yeah. So
Mhm.
to me, that's exciting because that much better approximates what they would do, right? If they created a company, right? If they joined a fund manager, things like that.
Mhm. No, obviously, I do think, to devour the applied section of the things with the creativity and the drive. Well, I do not think that, most of the professors in university will be happy to force their students with the amount of creativity that you force your students with. But I do think, giving them the ability to think about the applied material that the industry actually needs and how to force it with your academic with the well-known academic procedures. I do think that it's the way that actually needs to lead um, the new direction. And I do think it actually assemble a small hackathon when you're actually working with your students. And I do think that that direction is supposed to be forced immediately with how things are actually being researched nowadays.
Right. I'd say
Um,
the challenging thing is actually like the professors themselves have to commit to learning new stuff, right? And
mhm.
like when it used to be, when
Which
ChatGPT came out, I could design questions that ChatGPT could not answer, right? And then suddenly 6 months later, a new model comes out and it just like nails the homework, right? Just because it becomes much smarter. And so I'm constantly now having to review my material to ask, right? Is this right for students? Or look, if, is it defeating the purpose of what's the goal of each assignment, right? What's the point? And it is critical thinking, and it is also have to stay up to date with the technological developments. I'll quote what something I hear from my dad all the time. That's like, we're in the service industry as professors. We're not here to like, oh, we're special and smart. No, like we're serving the students, right? And for most of us, the biggest impact that most of us will have is on the teaching side because not everyone can be a Nobel Prize winner, right? And so then you take seriously this impact on students' lives, and we want to equip them with the right experience, with the right sense, soft skills, hard skills, knowledge, and so on. And yeah, I think that's what I feel like INSEAD's quite special.
Mhm. I do think that although everything is sounds pretty promising, we do have a minor fear, which is as the technology advances and the neural nets behind those models get wider with more layers. I do think that as technology itself increases its abilities, it can do the work for you. Now, being able to be in the loop and control, the advancement without, getting extracted out of the cycle, that's an art more of it is, a practical material that you can actually teach. Because you cannot, extract yourself from the loop, but you can you know, press the button and be in the loop without being in the loop. So in academia, I do think that might be the major threat for all professors and professional educators. And I do think, or I would love to ask you, how do you tackle that problem? Like obviously, it's going to be the student problem that way or another, but for you as a professor and as an educator, how do you, pursue a great solution to resolve that issue?
I mean, I asked myself what would be useful for the student. So there are two components. You can ask students what they want, right? Of course, we do that with the student feedback. That's not always amazing, right? To quote Henry Ford, right? If you ask the people what they want, they would say a faster horse, right? They might
Mhm.
not say, I want an automobile. And so you can ask them. But the second one is we are partly in the prediction game. Like I have to anticipate student needs in the future, right? That is, maybe they don't value it now, but later on when they go to interview or when they're in the job, they should look back and say, you know what, this assignment actually was like captured what I want to do quite well.
Mhm.
And so that's where I think having worked in industry, right, running a fund as well as being in academia, that part I think is really enjoyable for me because you could kind of close that gap. Most academics, right, they are extremely smart, talented, well educated, disciplined, and so on, right? But they see just one piece, right? Versus, for me, like the moment I try to teach them something, we also try to take it into the market, right? And again, the market is a very humbling thing, right? It's a pain distribution mechanism, and it's an adversarial system, right? The moment I have a good signal, everyone wants to find out what it is and then come crush me with it, right? And so it's
It is.
this
It's an
never-ending
efficient
fight,
system.
and coincidentally, that's the very first model we teach in class, right? That's like markets tend towards efficiency. They're not efficient all the time, every place, but to assume the market is stupid, that is a very dangerous game, right? And so we spend a lot of time, like in the fund, for example, trying to learn from the market. Just like in academia, we try to learn from the students, the feedback, not just from current students, but from alumni. So that part there, it's like really a network of people to say, hey, I taught you this. Was it useful when you interviewed, right? Or, this part is wrong or outdated. Like, let me know, right? So then if you ask like who, what is in a professor's toolkit, right? Our part of our human capital is not just right what we study, right, and what we research, but it's actually our network of students as well. So that becomes a tremendous point
And
of
that's
value.
superpower, and that's the actual superpower.
That's right. There's nothing, talk about using AI agents. You have something so far it's better than AI agents, right? It's a bunch of human connections, right? That, I taught them and then I can ask them to join happy hour for my class to network with other students, right? And kind of
They
share
never and
learnings.
and, and they never and they never have any token limitation, which is perfect.
That's right. No token limitation. There's some
No token
downtime.
limitation.
There's
Yeah,
some
well,
downtime. Servers may be
they're down.
unavailable.
They need to go to some break to have a bit of a break. But I do have a point here that I would like to highlight, which we spoken about before, and you testified about yourself that as long as you work in students in academia, you're actually getting much more humbled with how the industry apply things. And when you actually think of, new research types and new research subjects, and you like to apply them over your funds and to expand that adversarial system, then you are being much more humbled. I would like to clarify that point with you. How do you see it? What makes you to get more humbled? How do you increase your maturity in order to understand, okay, which research type is practical, which research type is actually practical and can get applied in my fund, and how I do map in the research base what I can or what I can't apply or disapply.
Yeah, so what does it mean to get humbled? So you see a lot of papers all the time. A lot of them actually not by finance academics, a lot by computer scientists who say, I coded an algorithm that can trade very well, right? And you take that and you say, great, let me replicate it. Maybe you can. Many times you cannot replicate it. It's like magic what they did. Sometimes you can replicate it. Great. I feel like I understand it. Let's take it to the market. And then you lose millions of dollars.
Mhm.
Actually, this learning is not unique to me. Actually, if you read, there's a great book called "The Man Who Solved the Market" by Gregory Zuckman, right, about Jim Simon.
Yeah, yeah,
You
yeah.
know, when we talk about how he started his company, he started reading academics' works. Finance academics at the time were the ones primarily with the data, and they were trying to replicate these strategies. And then his conclusion was this stuff doesn't work. The stuff that these professors write don't work.
Mhm.
And now we kind of start to see that amplified, right? If as more people can generate research, the market tends towards more and more efficiency, right? Because if you wrote something and it works, you should go out and make so much money that you correct the price so that it no longer works, right? And
Mhm.
so that's the nature of the beast. And so even if you discovered something that's true and it seems to work, some of the biggest companies in the world, right, in terms of the asset managers, we have the likes of Dimensional Fund Advisors, you have, AQR, right, which came out of the Goldman Sachs Asset Management Group that also, predates me from the same PhD program from Chicago. Um, they become big and successful, right? And so then they make the markets harder, right? So that's kind of the nature of the game.
Mhm.
So I view the lens, I view a lot of this stuff through the lens of like an agency thing. That is, if someone comes up to me and says, I have an amazing signal, right? Here you go. I'm going to post it publicly available.
Mhm.
My knee-jerk reaction is, if it's so good, why are you making it public? Right?
Mhm.
If it's so good, you should trade your own money or start a fund. And you
Mhm.
might say, okay, well, I don't want to raise
Most
money.
of
I
them
don't
will
want to
never
get a
publish.
license. Sorry?
Most of them will never publish the work.
Yeah, all the smart quants I know, they don't make anything public, right? Because their stuff actually
They
works,
don't
right?
make
And so they
themselves
keep
public.
it
They even
exactly,
don't
right? So
resell.
they're floating around on Twitter with some, right, anonymous, right, pseudonym, right?
Mhm.
And then once in a while they'll drop some wisdom, right? Of like, oh wow, these guys really know how the markets work.
Mhm.
And
Yeah,
so
well, obviously.
yeah, so those would be the type, you know, and then the ones who are out here saying, look, here's how AI can trade you six figures a month, right? All you need to do is take my class, pay me $500. All right, then I was like, oh, okay, great. What are the chances this will actually work? Right. And of
That's
course,
scary.
then myself as an educator, having students pay 5 to 6 figures to study with me, I have to think about, right? Am I really generating value for them? Right.
Yeah,
And
but
so it's something I wrestle
most,
with a lot.
yeah, but most never, like majority of educators in their rotation that actually seek for such an amount never wrestle with themselves if they know how to generate such a value for their students. which is a thing here, which is a thing, and I really wanted to touch about like about the coefficiency about sharing signals with the wider audiences. Quants are, and it actually very, very interesting. I was watching a video that was published 2 years ago that weekend from one of the biggest firms that we all know, and their head of commodities said that we're in a game, that we're thinking of everything as a piece, as a piece or an artifact, and we are actually gathering all those artifacts, understanding how the world actually works. We talk about with any professional opinion in yeah, with relation to to the company itself. It could be a geologist, it could be a surgeon if it's in the medical world. It could be anything. It could be a researcher in academia. It could be anyone that will get on board and try to explain how it might resemble or sound with their own assumptions. So they actually gathers all those artifacts and they model something, and based on their forecast, they're actually placing themselves in the market way, way, way before everybody actually think about the correspondent of the actual thing that will lead towards that market reaction. And I think that way of thinking actually expands when you are working in a way that actually that sounds exactly the same. So when you expand yourself, and when you expand your guidelines, and when you expand the way you think and the way you interact with people, and the way you actually gather and collect those artifacts, that makes you much more powerful with your understanding of how the market is supposed to react. Like if you would know that a CEO will buy or will purchase shares worth 10 or $15 million in his company, way before you would be able to place yourself in the market, way before everybody else. And I would like to ask you, Ben, well, we're speaking very much about creativity and about the adversarial system and having creativeness and gatherness with people, and obviously people do not have any token limitation, which we have mentioned previously, and um, and I would like to ask you, how do you force people to interact with others? How do you force people to think critically to solve problems that are actually occurring in our role, and coincidentally that will lead to a major profit in advance.
Yeah, I think so. It's teaching in a field like finance, because so much of it can be applied into the market directly, right? We spoke about this earlier.
Mhm.
I think one pitfall of that actually is to also be short-sighted, right? Or I think, part of our role as educators is also not just to teach them how the world works, at least to the best of our understanding. Of course, we might be wrong, but to give them frameworks to think about the world. But also, like, again, because in some sense, and to some students, not to all, right? We also act as mentors, right? And guidance counselors almost, right? For their careers. So there, I think I'll rely a bit more on kind of the moral obligation of how to help someone become a financial professional. What I have in mind is this. There are trading strategies known as those loading on tail risk, for example, that have amazing Sharpe ratios, right? So this is the Blushing Quants podcast, right? And so, I'll use quant terms. And so,
I see you blush. I see you blush.
so there's amazing Sharpe ratios out there, right? But one way to get those good Sharpe ratios is to do things that look like selling out of the money puts, right? Or, writing options effectively. You
Mhm.
can actually trim a bit of your volatility, you convert it into tail risk, then you can up your expected return. That's actually a strategy that is profitable. You can raise a fund on that. right? And you can have a good career before a blow up ever happens, right? If it's like a rare enough disaster, right, it might not even manifest in your career. And so you could have a good 10, 15 years, make $500,000 a year, collect your thing, retire before this all blows up. And that's where I'd say, like, if I were a pure finance professional, I'd be a little bit more, practical in that sense and say, look, that's a completely respectable career choice. But I think as an academic, I care also a little bit about the system, right? The financial system as a whole, where,
Mhm.
loading things into illiquid assets, for example, the fact that stuff doesn't get marked to market all the time, right? There are like real world consequences, even if it's rare, right? Like if and when it shows up, there's a lot of people who can get damaged by that. We're starting to see some of that, of course, crack with the private credit, right? I know it's not quite a quant topic, but it's the same mechanism, right? You can run quant strategies like that as well, right? And then just blow up once in a while. And then when you blow up, you just say, well, I had 20% per year for 5 years. I raised $1 billion. But I blow up, you know what? It's just like such a crazy event. Like, who could have known the US would attack, right? Something like that, right? And then just say, well, whatever. Like, I tried,
Trump,
we can start again. Yeah, Trump knew. So he's really changing the
Trump
risk
knew.
structure in the markets. Yeah. So,
You
he
cannot
himself
collect
becomes a
artifacts
risk
about
factor.
Trump, by the way. I do think it's not possible unless you prove me otherwise.
Yeah, so I trust, he's turning the system in something that was a little bit more like, what are the known unknowns, right? There's like an element of unknown unknowns now that's bigger, or
Mhm.
this thing called, right, Knightian uncertainty. And different people will have different ways to react. But one clear way, of course, is if I pay enough money and you get close enough to get the information, then you can profit. So I'm not thrilled the market's going in that direction, but it is the market we have to live with now. So as someone who's, a step or a couple steps removed from that, we do have to navigate tumultuous markets, right? And so then these lessons we have in risk management is incredibly important. So just as an example, that when we set up our flagship fund in Chicago Global, our first fund, we focused a lot on maximum drawdown, right? So we wanted to structure the fund such that we would never get
Really?
margin called. We always have some dry powder. That also meant we were not always levered up to our eyeballs, right? So that means we won't get forced to sell, but it also meant I couldn't juice everything up as much as I would like to get huge returns. But that was the trade-off that we were discussing, and it became a question of what is the investor's, risk tolerance. This
Mhm.
to your point, this
Then
is a bit of an art.
then you know
Right?
exactly what type of investor or what type of profile you're actually pursuing
Exactly.
to raise funds
That's
from.
right.
And
That's
I
right.
do
So
think that that's a very fascinating approach to look first about maximizing your drawdowns, know exactly your guidelines, and then constructing upon it your fund, which is, I think, a brilliant move.
yeah, there are
Most people
like
never consume that move, like never think about the opportunity to do such a thing, to
yeah,
focus
so I'd
on
say
maximizing drawdowns.
yeah, when I was in grad school, the joke was if you couldn't write a good academic research paper, you just take your work and then create a hedge fund, right? Long, short,
Great
30%
joke.
average return, sharp of one.
Great joke.
That's how you live your life. Imagine, like, that's the joke. The joke was, as a PhD student, worst case, you just go raise $100 million and
Mhm.
then trade. Um, that is the failure option. So that was kind of the interesting. It's almost like viewed as second class, right? Oh, first class, you'll be a professor, and then saying if it doesn't work out, then you become a practitioner. And I kind of listened to that. I actually started my PhD wanting to work in industry. I actually did a PhD wanting to go to a quant fund, and then of course, having gone to a quant fund briefly, um, I decided I want more control of my life as an academic. But I'd say like the there you raised a point just now, which is it's a bit of an art, right? It's even in a quant firm, you cannot just remove the person, right?
Mhm.
And in fact, even in AI companies, you cannot just remove people. How can you see this? You could see how much they're bidding for that talent. If anything, it makes the people more important, right? But not everyone and not equally, right? So there's so-called the jagged frontier, right? It's like the people who benefit will be kind of different groups. It does maximize a superstar effect, but I think the human component is incredibly important. So we just sit down. We said I with my co-founder, and when we decided How do you calibrate your fund? Does one statistically beat another? Yes, but at some cost, right? There's some trade-off. And at the end, it comes down to your point, which is, all right, if I design this fund this way, for whom is this a good fund? Who are the clients that we can attract, right? And can they tolerate this?
Mhm. No, okay, let's think about that calibration a bit more because I do think that um, having a proper calibration, I do, by the way, fix me if I'm wrong, I do not think that calibration is the rightest term to use in such a sense, but I do think that thinking about like maximizing drawdowns and understanding and understanding the rule book of the planned fund, that might sound very, very, very professional approach to tackle first how or to tackle first the understanding of what type of profiles you're actually looking for. And I would like to dive deep into the calibration process itself and understand with you how you think about that calibration. And I think it actually correspond perfectly with what we have spoken before about the critical thinking. Because critical thinking and calibration, in a sense that we're actually speaking about right now, is perfectly fit to each other, perfectly correlated to each other. So I would like to understand how do you think about that calibration process?
Yeah, so I think if you sit in America and you ask, hey, what do you need to run a hedge fund? It's quite clear because there's like a pretty fixed playbook. If you look in the hedge fund space, right?
In
Especially,
America?
especially quant. But yeah, global markets, hedge funds, it is a very, very US centric market. Okay, so if you just look at where are all the biggest investors in hedge funds, it's the US pension funds, endowment funds. Of course, then it became Europe grew quite a lot. And then Asia is now starting to pick up a little bit on that, right? But what that implies is actually if you're sitting in America, the playbook is a bit more well defined. You say, look, here's your, 30% average return, maximum drawdown, whatever, 15, 20, Sharpe ratio of one. You can attract a certain type of assets, right, from certain pension funds and so on. Um, but so, setting up Chicago Global, we called ourselves Chicago because me and the co-founders and the original team all came from the University of Chicago. And it's global because we're not sitting in Chicago. We wanted to bring the framework globally. And then we had to like go back to first principles, right? That is, I can't just do plus minus, Sharpe ratio of 30% average return. That might not be for all the investors because in Singapore, when we set up, it's a lot of family offices and their needs are different. Their risk exposures, their tolerance is different than a pension fund in the United States. Um, and so we had to rethink it from the ground up. So we just asked, again, it seems so obvious now. You just ask, for whom are you designing this product? Right. And
Mhm.
then when you ask for money, right, is it just from this set of clients? Of course, the market's been a bit distorted now in the quant space, right? Getting taken over by these mega funds, these pod shops, right? And the rules for pod shops, one of the benefits, so I wrote an INSEAD case on this on Millennium. One of the things the pod shop model brings is actually some level of standardization. So you know the terminology, you know the playbook. So you kind of, after a while, understand what does it take to make it to be able to enter into a pod shop and to be able to survive, right? Because everything is very well defined. Um, setting up our own fund, I think, is hard because it's kind of open world, right? Like, what are you designing? So even now we have long, short, right? Flagship fund. We have long only stuff. We manage stuff for banks that get sold to retail clients, of course, with all the right compliance and licensing. And so, it just became to me very interesting, right? And you mentioned this thing, creative, right? It's like, right, the world's your oyster, right? So we're just taking this goal of, wanting to invest intelligently and trying to scale it in different ways, right? And so we ended up, getting into all kinds of trouble in some sense because we get involved with a lot of different lines of business. Um, but that's also what makes it exciting for me, right? As a professor, like I am, always ask, like, what am I bringing to society? Like, why am I here? What's my calling, right? Can we expand access, right? Of course, licensing is difficult, so maybe we cannot expand fully, right? What kind of partnerships can we find? So that
Mhm.
kind of growth mindset, I don't know, it at some point just became very embedded into me, and it just became this thing that we're always thinking about. And so, when the fund management space is kind of where we started, because that's what I knew. My co-founder was a hedge fund allocator. He met with 1,000 fund management managers, kind of know their psychology. And so when we set up and created it, I came from Citadel, so it kind of knew a little bit about setting up these systems. Um, we just started with the fund because that's all we knew. And then over time, we realized, wait, there's something called separate managed accounts. And in
Mhm.
fact, it can give clients more customization and control and transparency. So it actually could be a very positive thing, right? If you manage the clients well. And then now with AI, we also then created another pillar of our business, which is on the AI B2B, like investment intelligence space, almost like analytics that's AI native. And so, it's evolving. I'd say now we're probably more like a fintech company, but it's nice because that kind of pushes me to stay at the frontier. Like to our
Mhm.
original discussion, if I were just a professor, not that it's bad, it's actually very comfortable, but the problem could be it's too comfortable, right? And so I just want to keep doing the same
Well,
stuff.
yeah, that's true.
Yeah, versus, in this kind of startup world, right? You're kind of constantly needing to evolve or
Yeah, but
die.
you
So
don't
you kind of
operate
balance it.
as a startup, but you do operate like as a fund. Am I right?
So we are Chicago Global Capital is licensed by the Monetary Authority of Singapore as a fund manager. So that's the license we hold. We also hold an exempt financial advisor license, meaning in addition to managing funds on behalf of people, we can provide financial advice, generate research reports, sell our research. So again, the idea was just like we want to propagate the IP, right? This way of, I think, investing in a quantitative driven, some people would call what we do less quant and more like quantamental, because we do have slightly longer holding periods than like a Citadel or Millennium. So we're not doing like sub-second trading. We're doing like weekly rebalancing. But that's where we realize there's like a sweet spot there because you have amazing funds fighting it out in the high frequency space. And I'm sure you'll have a lot of guests talking about the exciting world of high frequency. And then you have kind of the long-term investors, but we felt there's a gap in the mid-frequency space. And so that's where we live in the kind of weekly to monthly pattern.
And do you think that actually that well, I do guess that you found some interesting facts about how the market interact with a character like you or a character like Chicago Global as a mid frequency as a mid frequency weekly rebalancing fund. And I would like to ask you about how you think about quantitative advancements with that very conservative way of investing, because it actually resembles very right to you as an economic professor, but for most of the of I think it's the temptation itself from the market that actually pursuing, you know, being or investing in a high frequency or low frequency funds, and actually getting them and extracting or expanding the range and giving them with an insight of, hey, look, we are doing some each frequency weekly rebalancing, and we're built upon a very quantitative core. How do you actually approach those type of profiles? How do you actually approach those type of clients, investors, and how do you actually, you know, make the temptation even much more convincing than the mistransparency that you have in high frequency trading?
Yeah, I think the pitch for high frequency is clear, right? To say, look, I'm close to the servers, I trade super fast, we print money every day, until something blows up and then we may just disappear. And then, on the other extreme, right, it's long only, buy and hold, right? And of course, in the extreme version, it's like index investing. I think it's not that crazy to think like, if you're very high frequency, there's less opportunity and less I'm trying to find the right word for it. less focus on things related to, say, like fundamentals, right? Because a lot of it's going to be driven by market microstructure. That's generally what you're trading against. Now, granted, that market microstructure may be informed, right? Either informed or uninformed, right? And if it's informed, it might have something about fundamentals. And so you're going to try to look very tightly and react to that, right? In some sense, like, you don't care like what are Starbucks same store sales. All you care about as a market maker is there someone who knows that coming into the market? And if they know, can I adjust my bid and quote and offer appropriately? Right. And
Uh-huh.
so everything in the end gets reflected in the price. And so that's kind of it in its extreme. It's very, very clear. And I think, you know, at the mid frequency, there's still some opportunity that the market, I think, gets stuff wrong. In particular, like I think, we at Chicago Global have a bit more of an edge, like ex US, right? Meaning in the slightly less developed markets where there might not be enough analysts covering the stock, right? People ask, how can AI, help me invest? But many of these companies, there's not that much public data about them, right? And so, um, you have to do interpolation, you have to use alternative data sources. And so the cost of acquiring some of this stuff is quite high. And I think where like alternative data may help is not really in the super high frequency space, because at that point you don't even have enough time to ingest a lot of that data. I think mid frequency is where that stuff starts to manifest. So I would put an academic spin on it to say, look, when we think about signals, quant signals or whatever signal, it can be your gut feeling, honestly. Like, if you're a smart person and you think you're a good trader, your gut should be pretty much codified, right?
Mhm.
Like your gut feeling like reacts to some data, right? It's not just like I woke up with a stomach ache and say short everything, right? It's like I have this vibe. There we talk about vibe coding, right? Vibe research. And so what does it mean to have a good vibe? You have experience, you've seen a lot of the markets before, your lived experience. The whole point of quant investing is, can I learn something not from my own lived experience? I want to learn from other people's mistakes and other data sources, right? So you're trying to like leverage that to benefit from others. And so I think in the alternative data space, like the mid frequency becomes an interesting space to work in. And of course, if you're like rebalancing annually, again, getting like earnings right is not gonna make or break you probably, right? Because you're holding for a year. The market tends to get things right, hopefully by that point. And so I think the mid frequency space gives us enough of this buffer of how to trade. In some markets, we trade faster. We're talking daily. Um,
Mhm.
in some markets, we'll hold it for a month before we rotate something. But that's where we think that the market can get things wrong. So fundamentally, we think about signals in two dimensions. First, is it market inefficiency, right? Meaning the market's wrong. And if the market's wrong and we think we're right, you should hopefully see that fairly quickly, right? And at some point, the market may figure it out and your strategy stops working. And you should be fine, right? And be willing to live with that because the market tends to get smarter over time. And so then that's one type of signal. Another type of signal is maybe it seems to work all the time, like or fairly consistently, in which case we think maybe it's risk. Maybe it works because other people don't want to take that risk,
Mhm.
right? It doesn't mean we don't want to, right? Like we could have the risk-taking capacity, right, to take advantage of that. And so we're always balancing it. Is it like market inefficiency or is it some kind of risk factor? And of course,
But
there's
but but
just, yeah.
those are two distinct corners, like locating inefficiencies in the market. By the way, by the end of every session, I ask the guest, hey, what do you think that will happen to the market in the next year or next 2 years, which is a relatively short, very long period. But I do ask them, and I do, yeah, like, and I do hear consistently about their pursuit, about how do they like to pursue um, emerging markets. And that topic of emerging markets, I do think it's very, very tricky because locating inefficiencies, and obviously we all know and understand that the market tends to get very efficient as time goes by. And understanding, the other distinct corner that you have mentioned, which is understanding the market, understanding how can I participate in the market, which is like exactly the tail risk strategy that you were mentioning before, which is completely quantitative, but it's completely understanding the forces that actually gravitate to the price in the market itself, which is not actually forcing inefficiencies. It's actually riding upon the efficiency of the market itself, which is two distinct corners that have, like, I do think zero relation because you're actually approaching different markets, different types of the market, emerging, non-emerging market, and established markets. And I would like to ask you, first and foremost, I think it's the most appropriate question. Please fix me if I'm wrong. If I'm wrong, I would love to know. But I do think that for you, as a co-founder of Chicago Global, approaching those two distinct corners might benefit you with a very high diversity, um, but and diversification with how do you actually can approach things, but it will, take most of the power and most of the concentration from one another. So how do you actually make the sweet spot in between? Because there are two very, very difficult problems. And how do you actually be able or raise the transparency with inefficient market to an established market and understanding how to leverage your fund properly in between the two.
Right. I mean, that's part of that's like the holy grail, right? You talk to fund
That's the art.
managers.
That's the art that you bring to the table,
Yeah,
you
that
think.
so you talk to many fund managers in emerging markets and they'll say things like, this is a very technical market right now, right? Or there's like no risk-taking capacity, or there's too much risk-taking capacity, maybe in Korea, like coming into this year. Um, yeah, so the way we do it is we start quant, I think like we have each of us have our gut feeling, which we will always ask, like, can I codify this into a process? Is it really informed by the data?
Hmm.
And we try very hard to like update our beliefs with the data. But of course, our biases also guide how we do research. Like, where will I look? Which markets do we consider? What new data sets do we want to buy and scrape and clean up and assemble and all this stuff? Um, so having started, we start as a quant. The short answer is, if I'm not really sure, what do I do as a quant? I go Bayesian, right? I put some prior, like I think I have a prior belief. In some markets, that prior may be degenerate. In some markets, that prior may be non-degenerate, right? And we let the data inform us. And so by going Bayesian, all we're trying to do is just take into account the fact that I'm not quite sure how do I best mix, right? And surprisingly, like statistically, many times you cannot beat just equal weighting the different signals. Okay, most of the time. But certain points
That's
in time, you can actually be like, look, this strategy, the valuation. So, for example, we entered into like to second half of February in America wanting to go long energy. Why? Because energy seems undervalued relative to all the other commodities, relative to historical past, right? And so actually, when the attack started, right, when energy prices went up, that actually got a lift. Right. And so, was that because we believe there's some event happening? No, it's just kind of, here's the pattern. And with every dollar of bets that I want to take, I just want to take the bet that gives me the best, right, reward for risk possible. That's it. I just want to deploy capital efficiently. And ideally, for the same dollar, I want to take multiple bets. Right. So thankfully, that's very possible, right, in this space. I buy,
how
three
can you how
companies,
can
those
you
three
how can you
companies, a bet
increase
on multiple.
how can you increase the buying power for each and every single dollar so you would be able to wrap it over a very diversified risk exposure? Because you said that you're going to multiply your bet and with the same dollar, and
Right.
being able to increase your buying power for all those bets, that makes everything much more interesting, I would say. And by the way, I do have another question, so I would love if you can answer those two consecutive questions because I do think they're correlated to each other. I do not think it's a question, um, about the February 28th, 2026. We had a new war. U.S. and Israel are actually attacking Iran. Energy prices were in, I think, the highest price points since we saw for years. And I do remember that I spoke with a pricing company in the UK, and they told me, "Hey, please do not approach, please do not approach us until it's over." And I told them, "You are completely dreaming and not going to be to get to end very soon." And I do think that in terms of all those, great firms, and understanding how the market actually reacts to those occasions, um, we all knew that there is a very high intention in attacking Iran from the U.S. specifically the president himself. And I would like to ask from you, how do you take geopolitical events or worldwide occasions that are actually happening or gives a signal, and you actually propagate it to your own pipeline in the hedge fund, and knowing how to make the rightest bet, or knowing how to leverage your own fund based on those bets that you're supposed to take and manage it properly.
Right. Yeah, so I think the heart of that gets to this notion that it's a good point, a good time to clarify, right? Chicago Global, most of what we do is equities. And
Mhm.
equities are quite unique because um, when you buy a stock, it's not just a bet in one company, it's a bet on a bunch of stuff, right? Will the sector do well? Will the country do well, right? Our supply
Yeah, you're
chains,
not you're
right?
not going like in the sense of commodities, because commodities get impacted very rapidly. But the company itself is like a ramp of very much uh
Exactly. Because it's a very complex thing,
yeah,
right? Every bet in a stock is a compound bet,
and the
right? And
understanding of
then
how to model and forecast those companies gets even harder as long as you think that you are able to model the equity itself, because of
right.
all those ramifications, because it's an equity. But propagating, you see how much ramifications you have in the level of equities, in the level of banking and everything, is like in the lower level of the funnel.
Yeah, so the name of the game for hedge funds is, I think, should be, there's twofold. One is, can I clean up my signal so that I can better forecast, right, return drivers and the returns themselves. But very closely tied to that is also this idea of sanitization, right? Meaning I want to sanitize my bet. Like, what is the thesis, right? I mean, if you work in a pod shop, they obsess over this, and it's a huge part of why I think they've been incredibly successful. So if you come in, you say, I bet electric vehicles are going to go up, right? Then you should choose decide then, right? That's really just the first part to form the thesis. To form the execution of the thesis, I think that's where there's tremendous amount of value to be had. Even if people have the same information, the same data, the way they express it can be quite different, right? So you can say, all right, I'm going to bet, between BYD, right, or Tesla, right? Kind of go bottom of the chain there. And then there you kind of have to pick a winner, right? If Elon Musk wakes up and like loses it, you're loading up on some Musk risk, right? Which may or may not be what you want. Um, and so the
Because
name
it's a
of the
must
game
risk.
for most hedge funds is, yeah, if you believe in electric vehicles, I want to diversify away from the Elon Musk risk so that whoever wins in the electric vehicle space, so long as the sector wins, I want my portfolio to do well, right? And so that's where the long short component comes, right? So you can actually neutralize a lot of factors, a lot of unwanted bets, including some of this geopolitical stuff. Of course,
Mhm.
not all, right? That's like the nature of this. There's like differential risk exposures and so on. But I think, there are ways to cut risk, right? So just to say, let's long short as a protective measure. So people think, oh, long short is about making money on the long and the short. Of course, if possible. But more often than not, you're losing money on the short, but right, you're just using it to do risk control. So if something like this war breaks out, right, you're like relatively hedged.
Mhm.
It's quite interesting because, to your point, like not every strategy works all the time. So suppose I have a strategy that's quite good at finding fraud. Okay. Like if a company is a
Okay.
fraud, um,
Which
you
I
don't
think
want to short a fraud
it's
all
like
the
a net
time.
net. It's like a net net. No,
Oh,
it's like a net net.
you're not gonna get me to disclose any positions or names here, but
Yeah,
uh,
obviously, we will not. By the way, we're not gonna be disclosing everything. This is not a financial advice. Let's just highlight it. We're just speaking about the world of finance and how we see it from our own insight. Um, I think that the disclosure was enough persuasive. Please fix me if I'm wrong. Um, but finding fraud, I think, as a strategy, it's a very hard it's very hard to measure. Like that's a very hard strategy to approach with. And how do you approach such a thing and I do think it's very disappearing,
Yeah.
it's like it's a very well-known phenomenon, but it's very not forgotten. So
Yeah, so if you think about it, suppose I have a strategy that discovers fraud well, right? So the natural bet as a quant is let's short that company, right? But
mhm,
actually, if you think about it, that fraudulent companies probably got a higher risk exposure on a lot of stuff, on maybe something like hype or sentiment, right? And so there's a situation in which a fraudulent company may see their stock rise like 700%, right? And if you are short this thing, you're watching your face get ripped off, right? Because your position is losing more than 100%. Um, and so it's a very painful process. And the easiest thing to do is simply say, look, I think this is fraudulent. Let's not do anything. Just get out. Right? I think
mhm,
that's increasingly been what people are trying to do because betting against stuff like fraud has become quite painful. Why? Maybe because there's social media, right? You have Robinhood that maybe have like uninformed traders and so on. Market dynamics change. And of course, if you're known to like short a company and that CEO is very good and suave with social media, right? They can just go on social media and say, "Look, this hedge fund is shorting me." Right? Look, I'm trying to change the world, right? And fix everything and improve things for humanity. And look at these guys, these financiers in suits in Wall Street are just shorting us and betting on our demise. It's a tough business. I think for this reason, some of the very well-known, short biased managers, like Jim Chanos, right? You had Heidenberg Research, right, and the affiliated funds that he was working with. These are shutting down, right? Just because that business has gotten quite hard. And to your point, I think like you kind of need shorts to help discipline the market, right? Like if not, like how would who's incentivized to get stuff right, right? Buying stuff is easy, betting against it is much harder. Actually, this is why short signals tend to be more informative because it's costlier to do that. If you do that, you must be quite sure that that's the case, right? That's like one of the data points that we use as well in Chicago Global. If we see someone who's smart, who seems to specialize in this, start betting against the company, we think maybe they know something we don't. So let's try to learn from that.
mhm,
Um, but yeah, as a business, that is quite tough, right? And so I remember I spoke to some clients and we were telling them, hey, we are short these companies because we think they're not right, right? Meaning they're going to have to restate earnings, whatever. CEO might go to jail. In the end, they did end up going to jail, right? But you know the number of apology calls, right? And then someone said, look, if you know they're a fraud, but you think they're going to go up, just go long fraud. And it stuck with me, right? Because meaning there are market situations and regimes by which you will say, look, even if you think it's a fraud, like you might still want to go long fraud for a while before switching around. And that
mhm,
makes for a very exciting slash scary slash unnerving way to be operating a fund, right? So, certain pockets of the markets have become more detached from fundamentals, for example. So
mhm.
coming back to that mixing how much is risk versus how much is like mispricing. I think now mispricing can be going on for longer, right? And so if you're super high frequency, in fact, like you can't even trade those anymore, right? Because you need to be go sub-second, for example. And then if you're in the on the other extreme, rebalancing annually, right? That fraud might persist long enough to actually benefit you before it hurts.
Yeah,
Ultimately, it will hurt, right? Ultimately, but there's the
at the end
intermediate
of the day.
point.
Um, I do look, I do have something, I do have a confession. I am looking at, as I told you before we started the recording session, I told you that I'm looking at your LinkedIn in the middle of how you, of your response. I was looking at Chicago Global LinkedIn page, It's rhythm timeless strategies plus advanced technology. Now, obviously, we know that the market is itself is very chaotic, and it is very non-controllable and very hard to navigate in the market because of the you know insane amount of layers that actually correspond with the impact itself on each and every single asset. And technology, by the other hand, it is a non-advancing is like a non well, it is very advancing, but it is not it will never stuck. Like the advancement itself over the technology itself will never get stuck. And I would like to ask you, how do you actually intervene between those timeless strategies and the technology and the advancement of the technology itself? Because if you're hypothetically speaking, take an LSTM, which is long-term term memory. LSTM stands for long-term memory. That's like the advancement of long-term term memory is transformers, and transformers itself as technology is what stands behind all those models that we all like, which is ChatGPT, Claude, Perplexity, and its model is Narrator from NVIDIA and so on. And I would like to tackle those 10 strategies because what you have just spoken about, which is the fraud strategy, and that fraud strategy is I think it's a brainstorm that all quants have without any relation to where do they sit and where do they work. And and how to model and how to forecast properly those assumptions is heavily dependent on the technology itself. So I would like to understand, how do you clear your business goals? How do you understand your business goals? And based on your business goals, how do you fit the right technology, which is, again, an art more than it is, more than it's science.
Yeah, so when we talk about the new advances in modeling, right? The transformer model, attention is all you need, 2017, right? And then the later models coming in, and after that, and all the actually, Alibaba Quen has some
I will
amazing
tell
multimodal.
Yeah, I will tell you that "Tension is All You Need" is a great title for an academic paper. So if you would have to brainstorm with one of your associates about how to call to the paper,
Yeah,
go with the title. Go with the title. I would bet to go to with the title.
yeah, it's an amazing paper, and in fact, it was, I'd say, like genius because it distilled stuff in a very simple and extremely efficient way, right? So the two things that the model gave you is one, context. You need to know context. How far back do I look, right? And then the other is parallelization. So how can I do this and simulate more worlds? Um, I think where some of this stuff runs into some challenges is none of these advanced modeling techniques have really quite made it that successfully into things like time series forecasting. And part of this is because I think the stationarity of the data generating process is a challenge, right? Because finance is non-stationary. You have to transform it in a way that is stationary, but you would have good theories as to why certain predictors are not going to work, right? And then what you're going to end up capturing will be something like risk, like what I was describing before. Um, and so, at Chicago Global, we keep a very close eye on these new advances, and we try to implement it. Some stuff from prior labs who have like new cutting edge, right, developments in foundational tabular models. So the funny thing is, most of financial market stuff is like fairly well structured in terms of a data structure, right? Like your data sits in a box, right? Not like just a bunch of words. And of course, we use LLMs to help clean up that data, right, to structure it in a box more efficiently so we can use more analysis and so on. Um, but
But
there
that's
still
exactly
hasn't,
where the problem comes in. Well, if you will take unstructured data, a bunch of words, and you try to fit a curve to it in terms of data, that's completely different than your need in the technology itself to be interpretable and to understand how it actually derives decision, which is completely like the inability to do it with transformers, which is like the next advancement of LSTM. It is completely impossible. And I was working with temporal transformers that could bring you a bit of interpretability. And I read FINRA rules and FINRA page about how to implement it properly. And I found out that, although it's interpretable, it is completely neglectable because it is very not explainable to the GM.
Right.
That's another problem with the advancement of technology. And I was speaking with a professor here very recently. I will be uploading the episode uh, in a week or two. And he told me that he prefers to never advance this technology as long as something is fully functional. And I would like to ask you with how do you actually find that sweet spot in technology and again aligning it with your strategy and its business goals?
So I would say, like, in terms of the models and signals that we use, we always start very simple, right? To minimize overfitting, but the risk of overfitting, right? Which I'm sure, you have many quants coming in talking about that. A lot of
And the curse of
optimizers.
dimensionality.
Yeah, exactly. And then of
That's
course
the
some people may say there is a virtue of complexity, right? That is like a lot more data actually can help, and you can learn like very nuanced interactions of the world and so on. I think we're like very um we're very cautious about that. Generally, we like parsimony. And part of that is because I think these, again, to go back to what you mentioned about the other professor, um, if it's not broke, don't fix it, right? But in some sense, again, in financial markets is not like predicting the next token, right? Predicting returns means you have to get something right. The moment you beat anyone in the market, someone must be losing to the market, right? That's
Mhm.
the arithmetic of alpha, right? And so they don't want to lose either. So they're going to invest tremendously to try to get back. And so stuff is breaking constantly, like all the time. And so to the extent that we're talking about, trying to correct market inefficiencies, like we need to be very willing and able to hot swap new models, new data sets all the time. Actually, most of the models we use are fairly stable. We like tree-based type models. It tends to be better for the situations we're working with.
Brian Boost.
Yeah, so things like XGBoost, like super hard to beat, actually. I was mentioning just now, like there are frontier labs trying to develop foundational new models for tabular data. Many of them are based on trees, but they come pre-trained, right? So you can pre-train and then fine-tune and then deploy. It's really hard to beat basic stuff. XGBoost is just like really pretty good. Um, and so you can get like,
Fundamental model.
yeah, exactly. It'll get you like most of the way there. And then I'd rather spend time thinking about feature engineering rather than hot swapping models, generally. Okay. Now, where do we hot swap models most frequently? That is when we're talking to the engine. So we don't allow anything non-deterministic to touch our signals, mainly because we want to be able to reproduce. Replicability is number one.
Hmm.
And then to the extent that we're taking anything pre-trained, like a large language model, right? You can, yeah, there are papers showing you cannot like lobotomize it to take out its knowledge, right? Once it's pre-trained, it's there. So you can't say it like, hey, forget what happened in 2024. No, like if it's in the training set, it's always going to be there. You know what I mean? And so it's really hard to pull out look ahead bias. So there are professors, I know some at Chicago who are building chronologically consistent models. That means you have to like train an LLM from scratch using only the corpus up to, not including the future, right? And just kind of updating this over time, just so you can get something that's doesn't have that look ahead bias embedded in.
Hmm.
And then this is why, because it's these large language models are black boxy, right? And it's hard to understand, like Anthropic tries, right, to kind of like have a brain scan on Anthrop, right? But like for us, we use that stuff to actually talk to our data, meaning right? We have all our signals. We have like the 300 different variables, right? When we're talking about, hey, can you explain to my PM or my client, how did we calculate momentum? Like we have like 30 different ways to calculate it. How did we mix it? What's the loading now? Things like that. That is amazing, right? For using LLMs. So it never like adjusts the code directly, right? It doesn't just come up with new signals, but it's a way to interpret actually our deterministic setup, which used to be very complex.
Explainable AI.
Yes, exactly. So that's really the point. I mean, I don't know, will you call our engine on the signals AI? I think so. There are elements of it in there, right? But to an AI researcher, they just say, well, this is arithmetic. And I don't know. I don't know at which point linear algebra becomes AI.
Well,
Right?
yeah.
So we're passing through a bunch of matrices, right? Just if it's a big enough matrix, it's now AI. But yeah, the point being, right? Like we really focus on being able to replicate and explain. So if you imagine, imagine if you could ask Millennium System, how did it come up with this decision to buy this stock? How did you calculate these variables, right? That seems pretty amazing, right? Will they ever do that for you? Probably not, right? And so that's where I think, being a small manager, right, and being more transparent and flexible with clients, like this is actually part of our value proposition.
Mhm. No, very, very, very interesting approach, by the way. I do think that knowing exactly, like going for simplicity, I do think that it's the most mature decision that you can take in terms of model selection. Because although your model is very, very advanced, that not necessarily mean that it will be interpretable, and not knowing what it actually means, like that could influence your entire decision making process and your entire capital. And I would like to dive deep into that discussion a bit more. Um, and talking about overfitting and even talking about the data, because everything starts with the data. I would like to understand, how do you actually derive the data? How do you think about feature engineering in a sense? What is, or how do you build your architecture? Because I heard that, and that's what I do. I don't like propose putting the ML model in the middle of the architecture. I would like to extract all the features. I would like to extract the weights. I would like to extract everything that I could probably able to extract, and then train the machine learning model, because that is a benefit. That not supposed to be a piece of the architecture, and everybody has their own type of architecture. And I would like to think or brainstorm together with you, how do you actually build that type of architecture that can benefit your business goals? And obviously that's very diversified, because every business
Right.
goal that's for himself.
I think you also need to start, you have to ask, I think, what is your starting point, right? If you ask Rich Sutton, right, kind of father of reinforcement learning, his answer is start blank slate, because the moment you start with a human, humans are imperfect. Start
Mhm.
blank slate so you can build God. I don't know, right? But that's his stance, right? Everything can be solved with reinforcement learning. Um, I think when we start, the point of where we start is we start with a human, meaning like we have some sense or some theory as to why. So to me, like we focus quite a lot on economic theory. Why do we think a signal works? Right? Is it inefficiency or is it risk? If it's risk, is this the best way to measure risk? Is the accounting, definition appropriate, or should we undo some stuff to clean it up? So that's where I think, our bias is actually because we started as finance geeks and nerds, right, and academics. We're kind of biased towards having, to your point, explainability, right? And so I want to also understand, like, why would something work? In what world would this actually emerge, right, as a strategy that would generate something that I'm seeing in the data? Now, what does that help us do? It helps us, I think, navigate and guide. So effectively, theorizing allows us to do like another experiment in our head, right?
Mhm.
This is a theory. If this is true, here are my hypothesis, right? So we don't start
Yeah.
with like a completely uninformed thing. It allows us to apply the scientific method, right? To say yes, no, yes, no, yes, no. Now, of course, you have to do your appropriate, corrections to standard errors and stuff like multiple testing, of course. But the fact is, like, once you have some theory, when the times are tough, meaning like when some signal doesn't work, you can ask yourself, right? Is it not working in a way that's aligned with theory? Like, did I, maybe I can't predict it, but is it reasonable that this happened? For
Mhm.
example, when some strategy loses money, do I double down or do I cut loss? Well, it depends a lot on why did we think it worked, right? If we thought it worked because, some markets are undervalued, I mean, they can get undervalued for a very long time, right? But as the price keeps falling, it might become more attractive, right? That's kind of the Warren Buffett, right? And then on the flip side, if it's about market inefficiency, right? If it doesn't start to work pretty soon, maybe we exit, right? So we're much more willing to cut loss and take profit, for example, on those types of strategies. And so we have this mix to we diversify all these different signals, right? You can think about mixing versus integration. So we have a bit of both in there, depending on the kind. But I'd say like the theory is very important because then when stuff like COVID hits, when stuff like the Russia-Ukraine attacks, right? When stuff like the US-Israel attack on Iran, when these things happen, it allows you to navigate the world a little better, right?
Mhm. Yeah, well, obviously, I do think that again, talking back to our to the initiation of our conversation, gathering those artifacts, understanding how the market are actually being changed or being influenced from geopolitical events, I think that way of understanding might benefit, fine tune and calibrate a bit more of the business goals to your own fun aspirations. And I do think that's the rightest approach. Now, I would like to dive into our last topic for today's session, if it's okay with you. I would like to talk about being a fund manager, which is a very, very broad point, to be frank with you. But I would like to speak about fundraising because fundraising is a thing that it's very non-trivial. Most of the PMs and the fund managers are you know it stands like it stands as an art more than a brutal science and each PM has its own way to navigate through the fundraising process. And I would like to ask you, how do you see fundraising? How do you approach investors? How do you um, persuade or talk your own proposition and craft your own product to fit to their narratives, and how it actually everything corresponds to each other perfectly.
Yeah, I'd say like, being a professor, I wasn't a very good salesman starting out, right? So kind of learn it one mistake at a time. Um, I think, we touched a little bit upon this when we were discussing um, designing, right? The kind of the art of designing a portfolio just now. Like for whom is this a good portfolio? I wouldn't say I'm a very good salesperson. Like we have met clients who, when they looked at the performance, they asked us, hey, given this, why aren't you bigger? And so I keep thinking, well, we're not bigger maybe because we couldn't raise properly. Because maybe we're not pitching it well. Um, but yeah, I think, I've seen pitches where people say, hey, this fund doesn't lose money. That's always a very dangerous pitch, right? It might be easy to get the money in, but it also could leave quite quickly. Um, and then, there are people who can enter into a long short beta neutral fund and then compare you to the S&P 500, right? In which case, when I talk to my friends in hedge funds in America, they'll say like, then don't deal with these clients. But my answer to them is, well, I look around in Asia and like those are the clients I have, right? Those are the
Oh,
prospects. And so
so
they
you
might
take a
not
flight to the
be.
back to the US, back home.
Yeah, so we do talk to some, right? Yeah. So anyways, it's a mix. Like, you kind of ask who do you know and for whom this is an appropriate product. And generally we want to pitch it from the perspective of the investor, right? Like, would this add value to the investor's portfolio? Like it could add, higher return or add a diversifier. Now, here's something I learned the hard way. If you're a diversifier, so suppose you work with a family office that's fully allocated to America, just as an extreme example.
Uh-huh.
Um, what that implies is if you're a diversifier, you're like either the market in the US is up, in which case you tend to lag, right?
Mhm.
So if you don't lag, then you're not a diversifier, right? Then you're like always kind of correlated with the market. And then the flip side, if the market is down a lot and you're not down or you're down less, right? It doesn't mean they can like allocate a bunch. So let me be a bit concrete. So we had a client and they would call us and say, look, we are up 10, but the market's up 25. So you lost to the S&P, right? And in the next year, the S&P drops 20% and we're up 2. The client says, oh, my checkings account did better than you. And I cannot, even though you did well relatively, I can't give you more money because I'm down in everything else. So actually, that's what it means to live the life of a diversifier, right? Now, if
Yeah.
you deal with the endowment, right, with a proper investment committee, that could actually you're doing your job, right, as the alpha back bucket that's uncorrelated to the market. But not every client understands that. So I would say like a big part of client management is also the education piece. Um, Specifically once you start leaving like the very fixed playbook on like the standard fund investors. And so, it's right. Like sometimes I talk to a potential client and it's like, yeah, I don't think they would be the right client for us, right? Because, they're gonna like enter right when we outperformed a lot. And if we mean revert back down a little bit, they'll become upset, right? And so you kind of have to stage it. Of course, it's like very hard to say no to a client, at least from given our size. If you're a millennium, you can say no all day, right? And you can lock people up for three
Yeah, well,
years.
obviously. But
Yeah.
liquidate their money and give it back, that's a problem. And I think that's the major threat of having a deal with a new client. As long as you don't think that there could benefit you, and you can benefit them, together, like and going together with each other.
That's right. And I think the answer to us became, okay, well, how do we diversify business revenue? What ended up happening is we then do more custom mandates, right? Because we now have this better tech platform. We can track and run a bunch more separate managed accounts, which may not all be correlated. Maybe they're not all in the same markets, right? Not the same factors, not the same horizon, not the same kind of financial terms. And so that's how we kind of try to stabilize at least the business side. And then that kind of really got us started thinking about, how can we become like an AI firm, right? Because AI native firm to deploy our IP even broader than that, right? Effectively, like, is there a way for us to advise, $1 trillion in assets without needing to run 300 funds or 3,000 funds? And I think the kind of financial advisory, the AI enabled investment advice component, this kind of investment intelligence layer that we've developed called Parallax. I think that'll be the way
Great
to do
name.
it.
Great name, by the way.
Thank
Great
you. It again starts with this multiple angles, right? We're viewing stuff from multiple angles. Is it mispricing or is it fundamentals? Best case, it looks good on both angles, right? And then we really like that stuff.
name. Okay, brilliant. Ben, what can I say more than just how great the discussion was?
Oh, it's my pleasure. Yeah, thank you.
Uh,
You asked some tough questions, so I had to kind of pause and think a little bit because I didn't want to get it right. Yeah.
So thank you. I don't think that the joke is good, but in the last sessions that I'm recording, and the guests tell me, "Oh, you had a great question." I'm always saying, "Yeah, thank you. That's why nobody pays me for it. No one pays me for it." Asking the hard questions. But again, that's the entire narrative of the blockchain quants. Ask the hard question, the people who actually leads the industry, and I had the pleasure to and I'm honestly have the privilege to do to be the one who asks the hard questions. And I really want to thank you for your participation. It really was a great discussion. I have enjoyed it a lot. I have learned a lot. I think that your approach to the world of academia and how it corresponds to the industry and how to leverage academia properly and apply things and get and get on top of the advancements very, very rapidly is an art. And I do think that I have learned so much from that discussion. So thank you very much for your participation. It was a pleasure to have you here.
Great. Yeah, it's my pleasure to join you today. Thank you for having me.
Thank you. And everybody who listened till that point, I would like to thank you. And again, Ben, thank you very, very much. And until next time, see you then. I never had I never knew how to close a session, but thank you.
All right.
That's always challenging, you know.
Yeah.
Bye,
Bye bye.
everybody.
Peace out.